So welcome everyone to Navigating Business with Tom Paper and myself, Steve Bazant. We have a very, very exciting topic today. We're talking about cash flow modeling. And the goal is to demystify cash flow for small businesses. So that's the lens and the scope here today. A little bit about us, Tom, give a quick overview.
Yeah, so I'm the founder of Webster Pacific 20 years ago, but before that, I was president of Lewis Bolton Nut Company and also of Premier Roasters, a coffee roasting company. And then I was CFO of Mendocino Redwood Company. And for the last 20 years, I've been helping companies think about problems and bring a data-driven and hopefully wisdom-driven ability to help guide them on their path. And I love it.
All right. I'm Steve Bazant. I'm a partner here at Webster Pacific. Can't believe it's been almost a decade that I've been here. Excited to be here today. I've managed what feels like now quite a few clients, mostly in financial strategy and operations strategy. I've held a few fractional CFO roles, mostly for small retail businesses, but also a farm. And I've got a team of 5 or 6 analysts that work with me. But just probably 5 or 6 years ago, I was in the analyst role myself. So I'm excited to bring that perspective too and dig into some actual cash flow models, which hopefully will add some value. We'll keep going here. A little bit about Webster Pacific. We're a boutique consulting firm. We've got 10 people located around the world. And our purpose is to help CEOs and founders of small businesses to optimize their business. So most of our clients are in the $1 to about $50 million in sales annually range. And our sweet spot is a client that is small enough that they might not have the budget or the bandwidth for a full-time CFO and a full-time analyst, but at the same time big enough that they're making serious strategic decisions that could really use some data as a backbone for those decisions. Okay. Going to go to you, Tom, for the agenda. Do you want to take over and share your screen here?
Yep.
Okay.
So I'm going to talk for 10 minutes or so about the different types of cash flow modeling. And then Steve's going to jump in and do a little demo, and then we've got time for questions. Please feel free to put your questions into the chat at any time, and we'll try to get to them. I also just want to say I'm really gratified to see so many friends and relations here today. It really warms my heart to see you guys here, and just delighted to be sharing a little bit of what we do and how we can help our clients. So, look, why do companies do cash flow modeling in the first place? And so there's one kind that we're not going to talk about, and that's the one where your house is on fire, your hair is on fire, you're trying to make payroll, and so the only way you're planning your cash flow is to check your bank balance. We're not going to talk about that really. The main two ways are financial cash flows and operational cash flows. And financial cash flows are really, and I'm now down in the lower left side, they're really backward looking. You use structured categories. We're talking about the cash flows that are one of the 3 statements that accountants prepare for businesses, generally on a quarterly or annual basis. And most people will have had their first experience with cash flow by in this type. We really want to talk about operational cash flows, which are forward looking. You make up your own categories to serve your purposes, and you can do them really any time period you want. Look, the point of this, Eisenhower said, plans are nothing, planning is everything. It's not about the plan. It's about aligning usually your leadership and your finance group around what needs to happen, what will happen, so you don't run out of money. So just a little bit more fine point on the difference between these two things. When financial cash flows are done, they start with net income, which comes from the income statement, and then they make adjustments for things, operational things, investment things, financial things. But an operational cash flow starts with a bank statement, and you're just projecting inflows and outflows. So now I'm going to jump to the next slide. And this is a bit of an eye chart, but there's a lot of stuff in here that I think is really important to point out. So let's go on the right here. So look, profitable companies can have negative cash, and companies with positive cash can have negative profits. The differences are oftentimes spelled out between thinking about cash versus accrual accounting. And in the long run, cash and accrual will always be the same, but in the short run, they can have tremendous differences, which can bankrupt a business. When businesses, and Dave Drogos knows this well, he was my banker at the coffee company, when they're strapped for cash, they depend upon the confidence of customers and suppliers. As a leader of a business, it's important to be what I call appropriately honest. You need to be confident in your business. If you're not confident, your vendors aren't going to give you credit. So let's go over to the left here now. Cash flow management is a survival skill. It does not add long-term value to your business, but sometimes you just need to manage your cash to survive and move yourself forward. So what can you do? Well, the easiest thing is to pay slower, okay? Sometimes you got to choose who you're going to pay. You can get your suppliers to ship later. You can go to a guy like Dave Drogos and borrow money. In the coffee business, we had this borrowing base. We were borrowing based upon the value of our assets. I got into this business because the guys who were there before me were not being accurate with their borrowing bases. They were showing more receivables than they had. Don't do that. You can go to jail for that. Somebody in the jewelry business overstated their receivables in a publicly traded company and went to jail. A really good guy. And whether you're incompetent or you did it on purpose, people don't care. Personal guarantees. So that's a great way to borrow money because you're putting all of your personal assets at stake, and a lot of small businesses will make personal guarantees. What I would say is just be careful. I was with my dad in the bolt and nut business, and we needed to borrow money, and he gave me this piece of paper and said, "Here, sign this." And I signed it, and he gave it to the bankers, and I had personally guaranteed all of our debt. And later on, he said, "Now, I know you did that, but later in life, when you're a minority shareholder in a business, you might not want to do that because now you're on the hook for, everything in this business." But it is a way to raise money to borrow and to offer your personal guarantee. You can delay paying taxes. I never did not do that, and I would strongly encourage you not pay your payroll taxes or things like that to generate cash. Raising prices is probably the best way in the long run to generate money for your business. A lot of companies are afraid to do it. Collect what you're owed. I remember going, Dave Barry, who's on the line, will know this client who was in Elmira, New York, and I put on my best suit and drove from New York up to Elmira and showed up in person to collect the money that we were owed, and we got it. You can offer discounts for prompt payment. Managing your inventory, crucial to managing cash. Why make stuff for inventory when you're tight on cash? Make it to order instead. Sell excess inventory. Also, stop selling losers. You're never going to make it up in volume if the marginal profitability of a product is negative. But you need some sort of simplified cost accounting to do that. Again, back to the bolt and nut business. We stopped selling a particular product to Norfolk Southern because it was a loser. And we figured that out on a marginal basis by doing a really simple spreadsheet. So I think that I'm gonna stop there. Hold on, like Craig Lee mentioned, don't sign things that you don't read. You could get your business. Thanks, Craig. Craig knows my dad. All right, Steve, I'm gonna pass it back to you.
Okay. Let me go ahead, I'll share screen here. So Tom talked about two types of cash flow, right? We have financial cash flow, and then operational cash flow where we're making projections and trying to build an actionable model so that we can do pivots and project into the future to make better decisions around our cash. So this is a case study, redacted data. The example here is a swimsuit business, revenues, let's say about 10 million a year. And imagine that it's January of 2023. So we've got actual historicals for 2022, and then we're going to project into the 2023 year. So here, I want to make sure to talk about the mechanics of a cash flow model. So how it works, how cash flows through the business. I want to build the historical component. So how to populate all the data that you have from your bank transactions, and then use that to project and to think about 2023 and what the cash situation is going to look like for 12 months into the future. We're going to use all of that then to talk about two case studies here for this business. One, if you're sitting in January and sales end up being lower than you projected, or a second one, let's say some of the underlying assumptions maybe that were on your P&L or income statement, like the efficiency of your ad spend or your return rates, what have you, maybe those don't shake out to be exactly how you were expecting. Okay, so I'm going to dive in here. Go to our Excel model. Okay, Google Sheets actually. And I'm showing in Google Sheets today, there's a lot of great software tools out there that bigger businesses may use, but I think this is a great way to showcase this example here. So I'd like to start first by just talking about the mechanics. How does this work? So every column here is a month, and our cash SOM, cash start of month balance, could literally be the balance in your primary checking account on January 1, 2022, okay? And then in January, cash flows into that account, transactions in, cash flows out of that account to then get you to your ending balance for the month, okay? Now, the way cash flows is that this ending balance here is in January is also the start of February, right? And the model continues forward and forward, okay? So lots of data in here. Where did this come from? We've got transactions. So this, where there would be many more rows based on the size of your business here, but this is coming straight out of your checking account, right? All the transactions for 2022 you would plunk in here, and then you categorize them. I'm going to go back and go ahead.
And this is, well, I was just going to say, this is the work. Like,
right.
This is the work, is to take what has happened and organize it intelligently by categories. Too many is going to be a problem. Too few is going to be a problem.
Yeah, the categories are key, right? You don't want 40 so that you can't even fit them on one page and you're scrolling around. It's not actionable. You also don't want 2 because you need enough granularity to see where the biggest buckets are of where cash is moving in and out of your business. And this is different for everyone. It's just your judgment. So let's just soak this in 2022. I've got some heat map coloration going on here to draw your eye to the big ins and outs, greens and red. And so we know it's a swimsuit business. And what is this model telling us about the business that we look at it? Well, we see some seasonality here, right? We're getting much higher sales receipts in the summertime. Okay.
Hey, and Steve, I want to just jump in for a second. If anybody has questions about anything that we've talked about, we're doing good for time here. So if you have a question about anything, I'm seeing the questions from the chat as they're coming in. So, I encourage you to jump in early with your questions about whatever. We'll fit them in however we can.
Right. Thank you. Tom mentioned a little bit before, because you have a little extra time, many businesses will say to themselves, hey, I'm profitable on my income statement. I'm making money. I have positive net income, but I'm running out of cash. And how is that possible? So Tom talked a little bit about the difference between accrual and cash accounting, but this is the core differences that we're seeing here is in inventory. So inventory in an accrual basis on your income statement would be recognized in relation to the goods that you sell. So on the P&L, it's not when you make the payments, like on the cash flow, but you would see some proportion, maybe 30%, 40, 50% of the sale being recognized as a cost of goods sold on your P&L.
So this is, and I just want to put a fine point on this. Like
Yeah.
when you sell something, when you buy something, you don't necessarily have a cash impact. What happens in most businesses when they sell things is they generate an accounts receivable. That's not cash. And the last page of our document, Junior, we should put the slide deck in the chat so people could look at it. And there's a little debit and credit exercise with selling and buying stuff. So again, this statement here is not accounting. Now we say it's a $10 million business, but everything in the sales line is receipts. It's not revenues. And that may be a funky thing for people to wrap their head around if you haven't been exposed to this. But revenues happen on an accrual basis when you book a sale, but not when you collect money. And this document is showing the actual receipt.
Right. So for a business with, like in the retail business, you would book the sale when you ship the inventory to your wholesale account, let's say, and then that goes to AR, but it comes out of AR and into cash when you actually receive the payment, let's say 30 days later, right? So that's the difference here. Back to just thinking about what else this cash model tells us about the business. We are making large inventory payments in the spring and winter time to build up inventory for our peak sales in the summer, right? So what that does is cause a cash crunch or a need for cash, negative cash flow in winter months when you're paying all this money to get the goods that you need to sell in the summertime.
But
So
why? But Steve, this
yeah,
doesn't show. I mean, this shows the negatives off in October, November, December.
that's right. So let me go and just do a little breakout here. Anticipated that might come up. So there are different sub-summaries, like how you can group this information. In this row here, I'm summing all the ins and outs that are non-loan or equity items here. So, and then I have a separate for the loan items for the net cash, which then matches exactly the total net cash of the business. And what this shows is that we're in the red in the winter months, right? So, but we're drawing on our loan to cover that.
So Steve, your point is that this total here of those two components is the same as this total here.
That's right. That's exactly right. And the reason that we're not negative here, for one, I mean, this is our bank balance, right? We can't go negative in a checking account, right? So this has to be positive, and we'll get there when we project. Okay, I'm going to keep moving on to the projections, so we have time for questions here. Okay. So we've made some projections here into 2023. I want to make this, be an actionable, I want this to be actionable for small businesses that may be on the call. This may look complicated. It's basic Excel work that I'm doing here. So for sales, for example, I'm taking January of last year and I've built a little factor where I can scale that up or down from last year, right? 80-20. It doesn't have to be absolutely perfect. We're trying to come up with some reasonable projections that we can refine later if we need to, okay? Just another example, for paid social, I'm taking the prior month's sales and just assuming that 20% of that we had to spend on advertising, okay?
That is
All of
surprising, I think, to some people, is how much money is spent on paid social. And that's, we're talking about Facebook basically, and
Sure,
Instagram.
Facebook, Instagram, Google, paid search. Retail businesses will have, especially e-commerce dominant businesses, will have very high percentages of top line spent on advertising. Okay. So anyways, that's how the projections work. And again, back to the mechanics, the cash is just flowing through the model. So as long as we fill in all of these inputs for the whole year, then the cash flows. And now I want to draw your eye down to the cash end of month. this is what you should be laser focused on, because this is your projected bank balance every single month.
Ooh,
So
that's a problem.
yeah, you run this model, you're like, oh,
And
we're
what,
gonna
wait,
run
but
out of cash
let's just
in a
pause
month.
for a second. Like, why is it a problem? Like the first month is positive, but then the next 2 months are negative. And so you're going to get calls from your bank like, hey, you've
Yeah,
run out of money.
right. It's a huge problem. And again, this is that seasonality. We're seeing low sales, but we've placed a bunch of inventory orders because we're anticipating sales in the summertime, right? So what do we do about this? Well, we go back to last year and we drew on some loans. So let's just fill in. This would be, the question here would be, how much do we need to draw and when to stay cash flow positive under these assumptions, right? That's what a small business may ask. So let's put in 200,000 here. You'll see some interest pop up, right, as we add that in. Okay, now we're making it through February fine. March is still a problem. Let's go get a little buffer here and add another 200,000 in, okay? And now we've bridged the gap. So the answer to that question would be $400,000 will get us through with some cushion under these assumptions, okay?
But your bank may not let you borrow that much.
Right.
And maybe you're spending too much money on inventory.
Right. So let's, and this has happened before. So one of our clients was putting their own money into the business in the form of a loan, and the owner finally said in it's a different season, but let's say in February in this example, I'm just not going to put any more money in the business. We need to figure this out. We know that we're going to generate cash soon, but what are we going to do about this? And so that's when we go back to Tom's tactics page, right? And we look at all the different ways that we can generate cash. Okay. I think there are two things going on when you think about that. One is triage. What are you going to cut off first, and what are you not, what are you not going to cut off in terms of where you'll spend? So your people is a classic example of, you're always, always pay your people. But where else? So that's one, is prioritization. And then second is, where are the big buckets, right? Am I going to mess around with some small overhead category when I need $400,000 or whatever it is? It's like, no, well, I'm going to focus on the big lines here, and I'm going to go talk to, in this example, we went to our supplier and said, hey, we've got these huge payments coming in. We've already paid plenty of down payments in the fall. Can we get another month on this $200,000?
Steve, I'm going to interject here for a second, because we're going to run this ship, the train on time here. We can go out longer, but we want to finish up in 5 minutes. So I want to just put it back to the group here. Do you have any questions about anything? We'd love to hear your questions. If you want to unmute and say something, go ahead. And also, if you don't have a question, but I know there's some people on here who have significant cash flow management experience, do you have any thoughts on or advice about cash flow management you want to share with the group? I know Susan Beans is on the phone, who was my partner for 15 years. Dave Drogos is on. So if you guys don't have any questions or comments to add, Steve and I will keep going. But I wanted to at least pause for a minute and see if there were any questions. Hold on a second. Let me see who all is here.
He'll call on you. He's not afraid. This is like class. Turn your video off.
Oh, Susan, you're raising your hand. Go ahead, Susan. I'm going to unmute you.
Okay, I was saying we can't unmute ourselves, so.
Okay.
The only thing I wanted to add is that I've used cash flow forecasting tools like this, and I think, to Steve's point and to Tom's point, keeping it bigger picture is probably better, because these things need a lot of maintenance, right? If you're trying to get down to the last $100, with these tools. You're probably going to end up investing more time in it than it's worth. It just doesn't have that level of accuracy, but it gives you some runway to kind of see, okay, I probably got a problem coming up in 2 or 3 months. And then the second is, and this is, for me, it's been kind of I go one way, then I go the other. I try to make it as formulaic as possible, because if you're really managing cash closely, you have to update this monthly. Like AR can, and inventory, right, can change dramatically. And so you really have to update it pretty frequently if you're managing cash closely. And so it does help to make things formulaic. And if you guys have a template, I haven't updated one in a long time, but if you have one that's a good template to start with, I would love for you to share it.
Absolutely.
We do. And it's a great point about the practice, right? I mean, it is a constant practice to cash flow model. It's not like maybe your P&L budget, you're doing quarterly or biannually. We're doing this every month for most of our clients. And in some cases, when cash gets really tight, Tom, you mentioned in one of your slides, you'll go to daily, right? Or weekly, whatever it needs to be, as you get in those cash crunch periods. And Susan, I love the 80-20 point. I think that, yeah, it's great. Okay.
Ed's got it. Ed raised his hand. Hold on, Ed, I'll unmute you. There you go.
Hi.
Hi, Ed.
I just had a quick question in terms of, is the recommendation for all businesses to use a spreadsheet like this for wider modeling? Because, for some small businesses, we also have been using, for example, QuickBooks Online, and they have some basic limited cash flow planning tools, but it doesn't give a wider outlook such as this. I'm just curious as to what your thoughts are there.
I would say that the effort that you put into it has to be worth it. So if there's ERP tools are notorious for having a lot of bells and whistles and things that taking a lot of care and feeding, and that will stress your people out if all that effort is not worth what you're going to get out of it. So I think it's kind of a judgment. Spreadsheets are easy because, right, you can do them really quickly. So sorry, I'm not giving you an answer other than I think just be careful. Steve, I don't know what you would say about that.
There are a lot of great FP&A or financial planning tools out there. The native in QuickBooks is great too. I personally like to start in a spreadsheet because for me it's more adaptive. I can change things quickly in how I'm modeling something. And so for the clients that do want to implement an FP&A tool, the benefits being a lot of it's automated, right? There might be less care that you have to put in every month or every time you run the model. But I think the benefit of the spreadsheet is it's kind of the blank canvas and you're really building it here. And for the smallest businesses, this may be easier to learn and to keep updated than a piece of software. So it's a trade-off.
Well, look, this has been a lot of fun. We're at time. Steve, did you have any concluding remarks?
Well, yeah, I mean, there was a lot. I mean, I think Susan's point about 80-20ing or finding the right amount of complexity for these models is a super important point. You don't want to over-engineer it and then cause a bunch of hassle for yourself. Yeah, I think just making sure that this is actionable for your business, because a lot of times, you'll build models and don't build models just for the sake of building models, right? Use it if it's going to get your business to make a decision differently than it would have before. So if that isn't true, then it's probably not worth doing. Okay, Tom?
Oh, thank you. Thank you all for attending. This was really fun to see and hear from so many friends, and appreciate you all. Thank you.
Yeah, this is a gift. Thank you very much.